So wonderful evening, friends. Already two questions from mergers and acquisition has been shared in the playlist. So on that note, we'll be discussing another question that is test your knowledge 8. Before we proceed, just a quick background. It was asked in December 2021, also May 2019. A similar question was asked, but December 21 was straightforward question. So this is the background, and many candidates will be able to get at least first three parts easily. But the real catch is determine the maximum exchange ratio acceptable to shareholders of XYZ Limited. So apart from that, it's a fairly straightforward question. The bit of application will be solved. But in this video, we're going to see within how much time you should solve in the exam, because time factor also plays a pivotal role considering the MCQs and all that aspects. So XYZ Limited wants to purchase ABC Limited by exchanging 0.7 of a share for each share of ABC Limited. Relevant financial data as follows. Equity share outstanding, EPS, market price per share, everything is given. First one, illustrate the impact of the merger on EPS of both the companies. Next is the management of ABC Limited has quoted a share exchange ratio of 1:1 for the merger, assuming that P ratio of XY Limited will remain unchanged after the merger. What will be the gain for the merger for ABC Limited? Next is what will be the gain and loss to the shareholders of XY Limited. First is ABC angle. Next is XYZ angle. So determine the maximum exchange ratio acceptable to shareholders of XYZ Limited. This is the question. Let's quickly check how much time it will take so that you can maintain the same flow and intensity. So in the exam, you should ensure how much time we are taking. You should be able to try to solve the same duration in the exam. Because a bit of panic, a bit of mistakes tend to consume more time. So you should ensure you avoid to overcome all these things. So first one is equity share is given, EPS is given, from that profit can be formed out, and PE ratio is there. So from that market price per share will be 250 rupees for XYZ Limited, ABC Limited for rupees 160 for ABC Limited. So this is the first part, and with regarding moving on to the second, EPS after merger will be number of shares to be issued is 4 lakh into 0.7, because share exchange ratio is 0.7 given, so 2,80,000. Existing shares is 10 lakhs, so if you add both, you will get it as 12,80,000. So total profit is 4 crores plus 1.12 crore, that will give you 5 crore 12 lakhs. EPS is rupees 40. So moving on to the next one, impact of merger on EPS of both the companies. So EPS after merger, EPS before merger, so there is no movement, because 40 it remains the same. ABC is also 28. If you could recall, security valuation also, in case of rights issue, there will be no impact. So this is also on similar trends. Maybe you can use it for cross checking, because in case if similar question comes, if your answer there is any movement before and after merger, then there's an indication that you might have gone wrong somewhere. So next is gain from the merger of exchange ratios 1:1. So number of shares to be issued is 4 lakh. So total equity shares outstanding of the merger will be 14 lakhs. Total profit we just saw above, same. So and EPS will be 36.57. So market price of share will be 36.57 to 6.25. That will give you 228.56. The market price of before merger is 160. So the impact, that is the increase in market price, is 68.56. This is regarding to ABC Limited. Now take a look at gain or loss to the shareholders of XYZ Limited. Market price is 228.56. Market price before merger is 250. So in ABC it was loss, XYZ it is ABC it was profit, XYZ shareholders it is loss, that is rupees 21.44 per share. So last part, the maximum exchange ratio acceptable to XYZ Limited shareholders will be, you can focus on this, you can use this alternative because it is slightly easier. So earnings after merger will be 40 into 10 lakhs plus 28 into 4 lakhs, that will give you rupees 5,112 lakhs. P ratio of XY is at 6.25. So the market value of firm after merger is A into B, that is 526.25. That will give you rupees 3,200 lakhs, and existing value of shareholders is XYZ Limited is 2,500 lakhs. You can see the previous computation also. So 3,200 minus 2,500 will give you the value of merged entity, that is the synergy effect, is 700 lakhs. So market price per share is 250. So total number of shares to be issued, that is nothing but 700 lakhs divided by 250, that is 2.8 lakhs. So the maximum acceptable ratio shall be 2.8:4, that is 0.7 share of XYZ for 1 share of ABC Limited, which is nothing but the starting line of your question. So you can use this, cross check your answer as well. Within 5 minutes you are able to see you are able to solve this wonderful question. So same question, if it comes for 7 or 8 marks, if you are able to solve within 5 to 6 minutes, that means exemption is guaranteed for you. So keep up the incentive, always keep on switches.